April market whiplash.
So if you just came back from being away the entire month of April, you'd look and see basically a flat market. You'd also look around and see every investor's aged about a year during the month. Post the April 2nd Liberation Day, the markets had nearly 15% correction in just 3 days. Not unprecedented, but the rest of the month was. And in fact, in the past 75 years, we've never recovered a flat during a 10% correction or more during a month. But April's recovery was in fact the best rebound we've seen following a 10% intra-month correction. Of course, the cause and the solution to the pullback was the same: tariff policy uncertainty, and that remains at extreme levels. This in turn is causing implied volatility, which is a key driver for option premiums to increase, and that's one of the few benefits of this amount of volatility, and it's not just in the equity markets.
Bond vigilante impact.
Bond vigilantes is a term used to describe when investors are selling government bonds because of a perceived increase in the risk of a country. As those bonds are sold, the bond prices go down, and commensurately the yield or the interest rate on those bonds goes higher. Last time we saw that in the developed world was in the UK in 2022, when the then Prime Minister announced big spending without really a way to pay for it. Their longer-term rates gapped higher, and the media had a field day suggesting that a head of lettuce would outlast the Prime Minister. And it did. Unfortunately, that's not likely to be the case for the narrative around tariffs. And we do know that tariffs cause prices to increase, and therefore inflation expectations have also moved higher. On top of that, though, the policy uncertainty has caused the bond vigilantes, to be selling bonds and driving up yields in the US. And in fact, we have not seen a weekly move of the magnitude we saw in early April higher on the US 10-year bond yield since the early 2000s.
Soft data, soft landing.
The Chicago Fed National Activity Monitor, it's a composite of about 85 data points, and we use that as a proxy for where we're at in the moment, and it's still signaling a soft landing. Similarly, some of the hard data around things like durable goods and other key economic data have continued to come in reasonably strong. Admittedly, the bearish commentators could also argue, though, that prices have moved higher and the data has been skewed due to the front loading in advance of tariffs. All said, we do think, though, that the soft data is sending a message to policymakers on tariffs. Looking at regional data like the Dallas Fed Manufacturing Outlook, a very abrupt turn recently, while other regional data like the Philly Fed New Orders Index has had a very large move to the downside. At the same time, investor sentiment is terrible, and that's shown with the bull-bear ratio near lows, while other broader measures of consumers like the University of Michigan Consumer Sentiment have deteriorated very rapidly, and other data like inbound travel into the US also suggesting that things may be slowing. These are data points that are being watched not just by the market, but also by the policymakers. And so the question now is the result of the consumer stopping spending and businesses, are they likely to slow investment and risking a hard landing in the US? That still remains unknown, but what we can do is we can look to the most recent quarterly earnings to get some insights for the very short term.
Macro factors weigh on earnings.
This earnings season was heavily overshadowed by tariffs and geopolitics. Given the macro backdrop, it's no surprise that companies that even just had modest misses were under pressure, perhaps more so than they would be in a more normal environment. A great example would be the industry stalwart for managed care, United Health. It was sold aggressively following earnings, and in HHL, we were fortunate Eli Lilly posted strong obesity results on the same day with their oral drug and largely offset that negative impact. It does reinforce the need for diversification, and certainly that's been the case within HUTL, where the European utility exposure has been performing very strong. One of the dominant market themes over the past several years has been AI, and there were some concerns coming into this quarter that spending was going to slow and that was going to weigh in on the tech names. Fortunately, results from Meta and commentary from Microsoft helped to alleviate some of these concerns. And under the surface, the fact that generally companies were open to giving guidance did provide some additional comfort and helped with that rebound from early April. Above all, we're reminded diversity is very important in this environment, and especially with the elevated uncertainty around tariffs.
Subscribe to Harvest ETF's Insights. Join us and stay informed.